Well, welcome. I think this is our third webinar that we've done. This is our first one in the new office, so a little bit different. Well, backdrop probably looks the same, a little bit different backdrop, but it is different in the sense that we have another financial professional with us. Ida Reese is joining us today, and she actually just helped me with our refinance for my house, and it went really well. So I highly recommend her. And we just got to talking about some, what's going on in the market, and just decided that it'd be a good time to do a presentation just talking about home equity, because we're in a unique season where home equity or home prices are so high that it really creates some excess equity for a lot of folks. So she's going to talk a little bit about the market, a little bit of history, kind of some basic examples for about 20 minutes or so. Then I'm going to take the next 20 minutes and talk about what do we do with that home equity. So we've sold a house, we put a down payment on another house, and now we have the equity. And basically it's going to be a real simple financial plan, just some of the things that you should take note of and think about with those dollars. With that said, let me turn myself off and hand it over to Ida.
Well, good evening, everybody. My name is Ida Reese, and I'm very happy to join you this evening as a guest of Chris Holcomb, and his new office is beautiful. So you'll really enjoy it when you come to visit. So let's get started. We're going to be talking about practical uses of home equity after the sale, and I'm going to be talking about the real estate component of this. So let's get started. So what I'm going to be covering is, and this is a question we get a lot because, the way values have gone recently, it's almost reminiscent of the bubble era, 2006 to like 2009 or so. And then I'm going to talk about where national home equity is with median sales across the country. And actually our area is one of those really, probably not the typical, because the prices in this area are higher than the median national. And then we're going to talk about where your home equity could potentially be, and some examples of maybe a situation you might find yourself in, and is it time to sort of reevaluate selling your home and moving to another home. So those are the kind of things that we're going to talk about, and then Chris is going to take it from there. So the question remains, I just love this picture of this nice bubble with a house inside, and the little two fingers there with a pin to pin that bubble open. So the question is, does today's housing market resemble 2006? And that was not a good time in real estate or in the economy. So we're going to take a look at that. So what I'm showing you here is is a chart that was built on the U.S. Bureau of Census, and what you're seeing all the way to the left is tracking of housing, the median sales price nationally from 1960 all the way into 2021, the beginning of 2021. And then that yellow highlighted area right here with a little red line under it, those are the bubble years when, home prices went up very quickly. As you can see, that's a short period of time for us to hit that height, that peak there in the graph. But if you go back and let your eye follow all the way from the left, and you follow the red line instead of the peak with the yellow, it's pretty consistently going up. I mean, there's a little ups and downs there, but for the most part, the graph is increasing in value. So the question becomes, what does that mean today? So I'm going to take a look at facts and trends, because really that's the best place to go, because there's no guarantee of anything. Of course, we know that, but we can look at the facts and trends and see what the conditions were back in 2006, 7, and what they are today. And back in that era of the bubble, things were much different than they are today. So the first thing I want to talk to you about is mortgage-backed securities, which is what MBS stands for. So mortgage-backed securities are traded on the market like stocks on the stock exchange, there's a mortgage-backed securities market. And what that consists of is a security that is a wrapping up of several mortgages. So it could be your mortgage, your neighbor's mortgage, mortgages all over the county, maybe in, across the country. And then it is turned into a security, which is then traded on the open market. And mortgage-backed security trading has an effect on interest rates. Mortgage-backed security trading, of course, the marketplace has to have an appetite for a certain amount of risk. And back in 2006, there was a big appetite for lots of risk, or that's how they got traded, and that's how it contributed to the bubble. So basically, today there's been lots of regulation that has been put into place. But back then it was less regulation, and mortgages were traded there. And the one good thing about mortgage-backed securities and the way that market works is that it's a necessity in terms of keeping money flowing through the economy constantly. Because there used to be a time when, your local bank had deposits and they would lend money, and sometimes they would close their mortgage department because they didn't have any money. I'm really dating myself, but I did work for a bank many years ago when that did happen. And then became the era of the mortgage-backed security, which totally changed mortgage money availability across the country. So it's all good, but it started out with a pretty high appetite for risk. And that did filter into the mortgage industry, lenders, banks, et cetera. And one of the riskiest products out there, and I'm sure you've heard this term as a buzzword, subprime. Subprime was very risky product line back then. We joke about it, but we used to call them ninja loans, no income, no job, no asset, and get a loan. They were loans often based on lower credit scores and, just really the stability of an appraisal for the value of the property. So it was a very risky time in the mortgage industry. And then there came the enactment of the Dodd-Frank reform, and that was signed into law in July of 2010, which changed a lot of the way we do business in the mortgage industry. So I've been in the business 25 years. I saw this happen, obviously. And after Dodd-Frank, one of the main things they did is they made loan officers required licensing. There was no licensing prior to Dodd-Frank. And so anyone could get in the industry. When Dodd-Frank came into being, loan officers had to get licensed. We have to take a certain amount of education every year. It's all good. It's all good. Eliminated a lot of people who weren't serious about it, and left people like me and my colleagues and a bunch of others who are, take it seriously. And if we were to look at another factor that affected that bubble era was, there was more inventory back then. And there is much less inventory now. And if you go to the next point, demand, then the demand today is much higher. So of course, less inventory, more demand, just simple economics, it raises the prices. The demographics today, there used to be a time when the baby boomers dominated the marketplace. Today, it's the millennials and the younger generations that are going to start to dominate the marketplace. And, the millennials came in a little later than our generations. They're buying older and they're buying bigger prices sometimes too. So, and the interest rates back then were in the 6s. Today, they're in the low 3s. Sometimes you can get into the 2s. And so the interest rates are just about half of what they were back then, which hits affordability, which means that you can afford more house today. Yes, the prices are higher, but affordability is better. And I'm going to, in the next slide, I'll talk to you about income because that also affects affordability. And then home equity now is much greater. Back then, there was not a lot of home equity. Today, there are factors that affect home equity, and I'm going to cover that in one of the slides. So it's very encouraging. So let's go to the next one. So from 2006 to today, incomes have increased 55%, which is all good because that allows the buyer out there lower interest rates, greater income, they can afford more house. So that's another reason. And the demand is higher, supply less. So all those factors take into, make sense and take into account that that's going to raise prices. It's just a matter of demand versus supply and the ability to purchase higher prices with higher incomes and lower interest rates. Okay. Today, home equity is hitting record highs. I mean, last July of 2000, from July of 2020 to July of 2021, the World Property Journal records US home prices increased 18%. And you can find this, there's lots of sources to find this information, and that is huge. So across the country, the median home value is $350,000. Now, it's of course not the case around here, but across the country it is. And if you take into account an 18% increase in price, it went from $350,000 to $413,000. It's quite amazing. The other factor is that people have held on to their homes much longer. So 2008, earlier than 2008, the average life of a mortgage was 5 years. Today, it's 10 years or greater. So that means people are staying in their homes longer. They make more income. There's lower interest rates. There's more demand, and home prices are higher. I mean, it all flows together. Okay. So the question becomes, what are your housing goals? And is there a possibility that you could benefit from this? How could you benefit if you were to consider selling your home? And that's what we're talking about. Is it time to consider that? And oftentimes I will have conversations with clients and we review their goals, we look at everything, and maybe, I oftentimes, we decide, what, maybe not now, let's wait 6 months, or you're not ready yet, but let's get ready for it when you are, kind of a conversation. So if you wanted to reevaluate that, I would be most glad to do that. And there's no obligation, but it would be a reassessment, almost like when Chris does his planning with you. Not a bad idea. And it's a good idea to sort of reevaluate your housing goals as well and how that all fits in. So the next question becomes, well, wait a minute. And you've probably heard these stories from neighbors, friends, family, coworkers. Wait a minute. If I sell my house and it's a very hot market and I have no problem selling my house, where am I going? What's the next home that I'm going to buy? Okay, so this is a question that is on everyone's mind right now when they put their house on the market. And this is something we spend some time on. We have to, when I talk to a client and this is part of the consultation, which is part of the whole process. There's not extra fees for that. It's part of the whole process. We talk about a personalized mortgage strategy. So if that is your goal, then we would come up with plan A, plan B. There may be one preferred. We look at that one and then we say, well, what if this or that doesn't happen? What's the next thing we should look at? And then, if you don't have a realtor, I can help you find a realtor, but it's important for a lender to communicate and coach the realtor on loan options that work for you, so that you're always within the plan that you determine. I can show you your options, but it's really your decision as to what is going to work for you, because everybody has their own tailored plan and everybody has their own story and their own goals for their family. So maybe you're in this situation, or maybe you're not, or maybe you have a family member or someone that might be in this situation. And actually, this is quite common for what I've done recently. And that is, somebody bought a house a few years ago and maybe they paid $275,000 and now the house is worth much more. I used a $400,000 value here, which may or may not be, it depends on how long they held on to the house. But let's say the current home value is $400,000 and they didn't even realize that. So now we start evaluating, okay, let's do an estimate. What would they net from that home? and this is actually a scenario that I did recently. So they were going to net $150,000 from the sale of their home. And we set up the financing, and because the rates are so much lower and their income is higher, remember, when I went to help them with where would they go with a mortgage, their mortgage payment is not that much different than what they already had, because they had a higher rate from a different era. They had kept their mortgage long, they had their mortgage for a long time. So they only needed 80,000. They decided to trade up for a home that was priced at about 600,000. I just round everything off here to make it simpler to review. So that meant if they netted 150 and they only needed 80, what would they do with the remaining $70,000? And that's where Chris is going to answer that question in a minute. The next scenario is a move down scenario, and have actually worked with people on this as well. In fact, I have someone I'm working with now who is actually working on this plan. So she currently has a home with a current value of 800,000. And if she sells her home, she's going to net about 485,000. In this case, she wants to use this as a strategy to build a portfolio, but you can do a lot of things with money like this. And again, Chris is going to talk to you about that. So she decided to move down and buy a house for 400, but she only needed 96,500 cash. And so that left her with 388,500. So the question becomes, what can you do with 388,500? So that's my last slide, and thank you so much for allowing me to share.
Well, thank you, Ida. That was great. And we're going to talk a little bit about some ideas here and then open up some questions. So cue your questions as we do that. So what do we do with the home equity? So we clearly identified a case for 2, move up, home equity left over, move down, home equity left over. So what's the use of those funds? So what I'm going to do is I'm just going to go through some practical uses of the home equity, starting with the fundamentals and then moving up to some bigger goals. So certainly your emergency fund just needs to be restocked potentially. And I know that's fundamental, but sometimes it's the fundamentals that trip us up. We spend maybe new money on the house and we forget to replenish the emergency fund. So 3 months if you're feeling really secure about everything, your job, don't see any major expenses. 6 months if you have more seasonal or more risk in your job. And that just needs to go in a bank account. I'll have folks ask me all the time, hey, can I invest those funds? And I said, I love investing, but that's not a good use of those funds. They really just need to be in a safe, secure, bank savings account, CD, anything like that's fine. Principal protected account. And obviously the big reason for that is a job loss and unexpected expense. If you had to replace a roof suddenly, if you had to replace a car, something like that, had a temporary job loss, then that would be a good use for that. The other is pay off debt. Maybe you have some debt lingering from student loans or a car loan or credit cards that are out there. Knock that out too. We really are not a fan of consumer debt. The dollars that are used up for consumer debt typically steal from other goals that we have, like saving for retirement or saving for kids' college or other things like that. So knock out that consumer debt if you haven't done that already. So protection is a real important goal. Inventory your coverage. It's a really good time to relook at that and say, okay, my recommendation is that you have 10 times your income in life insurance. So let's just say a simple example, you make 100,000, 10 times would be $1 million. You X out what your employer provides you, maybe 2 or 3 times your salary, 1 time your salary, whatever that is, and cover that difference with a personal policy. That's something I could help you with. The advantage there is that when you leave that employer, you still have a personal policy in place. It's not dependent on an employer. Many times, if you try to take employer coverage with you, it's very expensive and usually not very practical to do that. So at least my recommendation is at least 10 times your income and at least half of your coverage private pay, so that if you are not working for a period of time, you still have a good bit of coverage. And don't forget disability. Disability is actually a bigger risk than life. Well, we all will pass away, of course, but the risk of disability is that you lose income and you have medical expenses at the same time. So disability coverage will pay for 60% of that, of your income, and then certainly help you get through that time. And it's time to reevaluate, do you still need coverage? Maybe you don't even need coverage anymore. So you should look at that. Or should you increase your coverage or change the type of coverage? Maybe you had term insurance and you want some insurance that's going to last until you pass away. Well, that would be some kind of permanent universal life coverage is what we typically use. So a good time to reevaluate that. Stuff that you maybe thought you couldn't afford before, but now you can. Complete or update your estate plan. So I run a class across couples, and it doesn't matter, young, old. When I say, hey, do you have a will? Many times the answer is no, and that's a big gap in a plan. That's how we protect our family. That's how we provide for our family. That's how we make sure that they know our wishes. It's not necessarily a fun conversation because it's an end-of-life conversation, but it's probably one of the last loving acts you can do for your family. And when I put it that way, usually folks are a little bit more motivated. But if your will hasn't been updated, certainly it makes sense to look at that and update it. Maybe children are gone, maybe there's more children, maybe there's more assets, maybe there's been a divorce or a new marriage, whatever. Good time to update the will. And if you have a lot of assets, it might make sense to look at a trust, or you need more control of the assets than provided in the will. So maybe a trust, maybe you're upgrading to a trust in lieu of the will. So revisit that. It's also make sure you have a financial medical power of attorney. So you're incapacitated. That's where a power of attorney takes over, and you need somebody to make a financial or medical decision for you. That's what that document does. And it's probably your spouse for the first one. So really the important piece of that is, who's your second person? Is it a brother or a sister? It's helpful if it's someone local, but naming that person is important. And the medical directive, that living will, you're going to pass away soon. What does that look like? Pain medicine, that kind of thing. So retirement planning. So many times there's not tax diversification in the plan. That is, there's no tax-free retirement accounts. I really love Roth IRAs. I love, folks to start them, to convert some of their retirement assets to Roth IRAs. It's just a really good tax planning vehicle, retirement planning vehicle, both to make sure that you have some. And we know we're in a season of tax increases. Every time a new administration comes in, they change the tax code. So if you have money in the Roth, at least you know that part of your retirement is not going to be impacted by changes in the tax law. So add or start to your Roth. If you've maxed out all your retirement accounts at work, or you're retired and you can't contribute to a Roth because the Roth is only earned income, then maybe you start a taxable account, just a brokerage account that doesn't have any tax advantages, but it also means it doesn't have any limits to it as well. So it doesn't have any minimums as to when you take money, put money in, take money out, no ages, no income limits, etc. Or maybe you start an annuity. Some folks, have pensions, so annuity probably is not appropriate. For others, though, they want more certainty in retirement. So ideally, if we can help you replace your income, your check, if you would, with guaranteed income, that is Social Security, and maybe there's a pension, or maybe add an annuity, that gives you a lot of peace of mind as far as knowing that you can cover your basic costs. And then your other funds, your IRAs, your 401ks, your Roth IRAs, are for the extra discretionary spending that will come. So a lot of things there that might work. College savings. So if you're behind on your college savings, or you just need to beef that up or start some, parent can put in $15,000 per year per parent into a 529. If your children are grown and you want to do something for your grandchildren, same thing. You can put in $15,000 per grandparent per child. So that gives you a lot of capacity to maybe use some of those dollars. Coverdale is an option too, but it has a much smaller yearly limit. So I typically don't see many folks use them. So just another opportunity. So you can see we're kind of going up the scale of, we started very practical, and we're going up to more higher end goals, higher end plans, and certainly we took them in a specific order because you want to take those, make sure you check those boxes first. So long-term care would be another one. So you're over 50, you're between 50 and 55, ideally. We should talk about the retirement disability. That's what I like to call it as well. This isn't covered by Medicare. Medicare only covers a few days of long-term care, but it's how you fund and then get help in managing that time. There's several ways to look at long-term care: traditional coverage, hybrid, where you marry it with a life insurance policy, or some paid up plans. Again, if you have any questions, we can talk some more about those. Here's my favorite one. Let's hopefully as we work together, we get to a point where all of those activities are checked, those boxes are checked, I like to say, and we can really think even beyond ourselves. How are we going to make an impact? How are we going to make a difference in this world that has provided for us? Can we give back to nonprofits, churches, charities, etc.? And it's really great if you can do that, out of some excess and just make a difference. You see a need, you hear about somebody that has a building program or needs some help with some other things they're trying to do, and it's a great time to pitch in if you have those excess funds to do that. Setting up a donor advised fund, I really like those accounts too. That's one way to accelerate your contribution. So the way that works is you can contribute to a donor advised fund, get the tax deduction in the year you make that contribution, but then not distribute the funds till future years. That's a really great tax planning tool, because I run across a lot of high income folks in the area that, excuse me, they don't have a means to really take any more tax deductions other than this tool. So this is a great way if you already have a giving plan in your life, in your family, and you've just been covering those goals year to year. Here's a way to double up on them. So basically you would itemize in the year you make the contribution to the donor advised fund, and then you use the standard deduction in the second year, and then keep doing that going forward. Or you're just going to leave assets to your family. Maybe that's part of your plan too, with some of those assets. So with that said, I know we went through those pretty quickly, but I just wanted to make sure we're hitting some fundamentals and we're looking at some other ideas that might be used for those excess home equity dollars. Her contact information is up there. Of course, my contact information. I think most of you have that, but just as a reminder, and we both will invite you to call us or set up a meeting if you have questions about any of these items, so that we can talk further and or maybe talk privately about what you're thinking about. Thank you, guys. Have a great evening.
Yes, have a great evening.
Take care.
Thank you.